do like to start off each one of the sessions that we do here live on Friday with a summary of what we saw happening in the market this week. And so East and I are going to kind of have a conversation about what we saw here. And this is the S&P 500 from the peak, the beginning of last year. And you can see that red line, is that trend line across the top. We hit it back in March. We hit it again December 13th. It's sort of like a live wire, unfortunately. We seem to get to it and then come back down. And that blue line is the 200-day moving average. We actually had 3 times here, in the recent past, the end of last year, beginning of this year, where we actually got above the 200-day moving average. That's significant, but we haven't held it, including this time, as far as that goes. So we'll see what happens. But we're not far from the 200-day moving average. We're not far from the red trend line either. And one thing that is different, if you look at the previous times where we got close to the trend line, it came pretty much straight down, right? I mean, all the way down. This time we started straight down, but then bottomed out, and we've come back up fairly quickly. So that's a good sign. One of the things I'm seeing is there's a lot of strength in the market as a whole. We're seeing that, in some of the more risky areas are starting to move. And so that's a sign that things could be changing, and we'll see how that plays out. We do have earnings season coming, right? And we're in the middle of it, and the big companies are coming out. And one of the big things that's being talked about right now is that earnings expectations are too high. And so the market, when it realizes that, as these earnings reports are reported, and future, future guidance comes along and says, hey, we think we're going to do worse, right? All of a sudden, you're going to get this, sell-off that's going to happen as the market readjusts for these new earnings projections going forward. And so that's really what we're kind of facing as a whole. That's the pressure against the market this first quarter and maybe even the second quarter of earnings reports that are going to come out this year. We're trying to see what the impact is of this higher cost, higher interest rate environment. How much does that impact earnings? And so right now, the analysts have projected that earnings would drop about 3.9% year over year. So fourth quarter of last year versus the fourth quarter of the year before, we should see a 3.9% drop. That's the first projected drop since the bad time in the pandemic, the first part of that 2020 downturn. So this is what we're going to be watching. But we had some very interesting things happen this week that I think are worth talking about. But for starters, I'll just show a chart. This is a 5-minute chart of the S&P 500 for this week, right? And you can see we started off the week kind of hanging in there, and all of a sudden we've had this big downturn section. And then actually the last part of that is all today, a really good run up today. So today is fairly easy to talk about, and I think one of the things that's the catalyst there is certainly the after-hours report from Netflix, right? I mean, the interesting thing about that, and last I checked, they're up in the 6 to 8% range, today. And the interesting thing about that report is they actually missed on their earnings, earnings per share. But they did really well in kind of the future guidance area, especially when you looked at the number of subscribers. So they were supposed to have 4.7 million new subscribers. They ended up with 7.7 million new subscribers, which is a really big jump. And this new version of where you can sign up for less cost with the ads has been going well. And so, here's the thing that the expectations for earnings coming into this quarter are lowered, and the pessimism is high. And these companies are great. I mean, they figure things out. I mean, Netflix certainly struggled, had some big drops last year, right? And now it's starting to come around. So these are the things that I'm hoping for. I think one of the rules of thumb that I always try to follow is that when everybody's saying it's going to do one thing and go one direction, so often it actually goes the other direction, or even if it does go that direction, it's already factored in because everybody's talking about it.
Yeah, the contrarian take.
Yeah, and so everybody thinks earnings are going to go down more than expected, right? And if they do, it might already be priced in. And if they happen to not do that, you could see quite a big movement upward, right?
Yeah, you can see that big jump for Netflix, you know. they were unexpectedly good.
Yeah, exactly. Now, we are heading into the next 2 weeks with the big companies, specifically the big tech companies that actually drive an index like this. So an Apple and a Microsoft and a, Google and such, which are such big companies on a capitalization basis, have more of an impact on this. And I think they could show some softness. Maybe it's already factored in. I mean, if you follow Apple's share price, it's not at a high point, that's for sure. Because there's problems in the supply chain for Apple, or the softening of the economy. We're hearing about layoffs. You were telling me something about the Microsoft layoff that I thought was interesting. So they had 10,000 layoff announced this week, but
Yeah, since the pandemic, they added about 40,000 jobs. So if
Right.
you factor in that 10,000 job decline, it's still a net 30,000 they've added.
yeah, and tech companies like that are kind of famous for trying to gather people when labor gets tight and hold on to them for a while. And now they're seeing some softness, in the overall scenario. So we're seeing some layoffs there and such too. And but here's the big thing I want to talk about here is that big downturn. All right, so that downturn, if you watch this on a kind of minute by minute basis, like I do, when the Federal Reserve governors came out this week, and there was 3 or 4 interviews altogether, the market went down because they were all very aggressive and essentially saying that rates were going to go higher, in some cases higher than expected, and stay there longer and longer than expected. And the market responded, and we ended up with this downturn. We'll probably still end up with a down week, even though we had the first 2 weeks were up, which was nice. So it works. They come out, and the object for what they're trying to do there is that if the stock market takes off, it eases financial conditions, which makes people spend more money, which of course creates more inflation, which is exactly what they're trying to fight. So they're trying to use their words in order to bring down the market and keep it, under control. Now, the thing is, it's sort of like crying wolf. They keep talking about it, and here we go. We're coming back already. These downturns that we were seeing that would last for months after these conversations are now really lasting for days, and the market's coming back around. And I guarantee you by next week when earnings are hitting, that's what we'll be talking about. We'll be and not what happened, not what the Fed said. But I do want to address what the Fed said. So if they're going to be higher for longer, you have to keep in mind that the Federal Reserve has been fairly inaccurate, let's say, so far. So go back to 2021, inflation is transitionary, right? Not so much. It's still here. And in September of 2021, they actually said that they would not be raising rates at all in 2022. Well, not so much. We ended up with, one of the biggest rate increases in history, especially on a percentage basis, happening in 2022. So what they're saying now is that rates are going to go higher in some cases than expected and stay up for the whole year, and they don't expect any decreases in 2023.
Yeah, and the market's only predicting probably 2 quarter point increases for the next couple months.
That's exactly right. And so there's some different ways of looking at that, and I've got some charts here. So number one, here's the 2-year Treasury yield, which is very sensitive to federal fund increase rates. It's the one to follow, in my opinion. And you can see it peaked out and it's been coming down. And even after these aggressive comments, it actually went down this week. The yield went down. And so the bond market is saying that things are going to get softer in the future and inflation isn't going to be as much of a problem. It's going to continue to improve, at least on a projection basis. That's what the bond market. So you got the bond market making a projection and you got the Federal Reserve making a projection. But if you go back and look at the 2-year Treasury back in September when they said they weren't going to be raising rates, it was already starting to go up. And so the bond market's been more accurate than the Federal Reserve. And so the bond market is saying, no, you're not going to be raising rates as more than expected, and you might not be keeping them up all year long. And another view of that is the Fed funds futures market. And so what this does is kind of make a guesstimate for where the Fed funds rate will be, in this case, in July of this year. And you can see the little down arrow. It's kind of flat, really, but It was at 5.1%. It's now at 4.9. So to get back to your quarter point increases, the market right now expects a quarter point increase in February and another one in March, and then things would stop, and because this is going all the way out to July. And so 4.9 is about 0.5% higher than where we are right now, and so it's all built into one projection there. So I would probably spend more time looking at what the markets are projecting and actually looking at what the Fed does more than what they say they're going to do. Because they might be saying what they're saying just to try to bring the market down, and they won't actually end up executing that. There is a fear, rightfully so, that the Fed will overraise rates, that they will actually do what they're talking about, and that's what scares the market the most.
Yeah, the market's seen a lot of, there's been mixed data coming out in economic reports, but people are getting a feel that there's softening of the economy.
Yeah, on the big day where things dropped, if we go back to this chart, that biggest drop right there, we had a report coming out saying consumer sales was slowing down. At the same time, we had an interview in the Wall Street Journal by the St. Louis Fed president saying he's going to raise rates to 5.5%, or thinks 5.5 is a number we might get to. And again, remember the market's thinking 4.9. And so that scares the market, because if they're not looking at the data and not paying attention to the data, they could overraise rates. And the data is showing some softening. And you can see that in the Microsoft layoff, even though they've had a net, increase. Still, they're talking about seeing some things in cloud computing in different areas. So, the last part I'll show you here is the Fed funds rate market for July of 2024, a year from the last chart. And that's down quite a bit. As a matter of fact, it's hard to see this, but the projection is that the Fed fund rate will fall to 3.4%.
Yeah, and that's essentially saying that people are predicting a recession of some sort, and Fed has to reduce their rates.
That's right. And so here's the Fed saying we're not going to reduce rates in 2023. Here's the futures market saying, hey, by 2024, you're going to be quite a bit lower. And so there is an expectation that we might see some dropping of the interest rates in the second half of this year, especially because that's when we're starting to see the most likely outcome of recession starting at that point in time. And so again, what does the Federal Reserve say they're going to do? What do they actually do? These will be really important components. And then, of course, this recession that it looks likely, right? With you look at most of the different, including this is a decent indicator for what might be happening, because they're not going to be lowering rates unless inflation is down quite a bit, and there is enough reason on a recessionary basis to do so, right? Yeah. So that's exactly what this is saying. But how steep is that recession, and how much does that impact earnings is the ultimate question. And that's the part that I think we'll be focusing more and more on. It's why this quarter's earnings are so important, next quarter's earnings are so important, because we're going to be able to find out how much of an impact all of this has had on earnings. But under the surface here, we've got a scenario where households are still fairly sound. They're borrowing more, and credit card debt's going up and what have you, but still fairly sound. Look at businesses. They were able to refinance at these low rates all of their debts and what have you. Businesses as a whole are still fairly sound. And maybe most importantly, banks are sound, and mainly because of the 2008 disaster. Banks have been forced to, do different things, and so they're in a better position than they have been. So that big 2008 downturn happened because of the financial crisis. We don't have that type of mixture here. We have China, right? Mm-hmm. And so they've reopened. How does that impact things? And so, what goes on here is really just trying to determine what the severity of that recession is going to be, right? And that's what we're going to be watching. The fact that consumer sales dropped says, okay, that is a recessionary issue. But in an inflationary environment, consumer sales have to drop. Mm-hmm. The fact that there's layoffs at Microsoft and now Google today with 12,000 people, well, that's normally a recessionary kind of indicator. But at the same time, labor costs and the tight labor market is creating inflation right now. So again, we actually have to have this slowdown in order to have inflation kind of come down. It's just a matter of how much. The perfect zone, kind of that Goldilocks zone where the markets kind of can do quite well in this environment, because there is a lot of pent-up demand to spend. China is going to get through this COVID aspect and unleash that massive population, the second largest economy in the world, to go out and travel and spend money and what have you. So that offsets recession, but also brings back in the possibility of inflationary pressure. So we've got two things we're dealing with here that are kind of polar opposites, and it's a really, really interesting environment to be studying. So anyway, that's what we see happening right now. I think things are still pretty good. We'll know more over the next few weeks as these earnings reports come out. Again, there's so much pessimism about those reports. I wouldn't be surprised to see the market hold up, even if some of that comes to be true. The debt ceiling issue, there's so much going on in the debt ceiling right now, the conversations. But again, if you look back over time, the debt ceiling impact has been less and less. So again, it's sort of like the boy crying wolf, go back to 2011 when we had a really big one. The market dropped 17%. If you look at 2021, the first argument over debt ceiling, the market dropped 10%, but the second one, it dropped 5%. So, again, people are looking at this as potential buying opportunity if there isn't a default, which would be catastrophic. But if there isn't, there's maybe less and less impact to the markets that happen there too. So generally speaking, again, things that people are talking about a lot are already kind of factored into the market. And so it's more the things that we're not talking about that we need to be concerned with. And one thing we don't know is earnings, because they're protected and they're kind of hidden, and we don't find out until they announce it. I don't think anybody expected Netflix to have that many new subscribers, for example, right? So good stuff altogether.